So today we'll be studying the unit number 3, financing decisions. We have completed the first two chapters. First chapter was introduction to financial management. Second was time value of money. Now today we'll be studying the third unit, financing decisions. So this is the chapter very important from the perspective of question paper point of view. Most of your section B and C, theory and practical, will be coming from this chapter. Let's look at the contents. So we're going to study the meaning and the concept of the capital structure. We're going to study the factors influencing capital structure. This is a very important topic or a question. Optimum capital structure, and then we'll study computation and analysis of EBIT and EPS. So the last computation means we are going to solve problems, that is section B and section C questions. Earnings before interest and tax and earnings per share. So on both these topics we'll be solving questions. Starting with the meaning of capital structure. What is the meaning of capital structure? It refers to the amount of debt or equity employed by a firm to fund its operations and finance its assets. A firm's capital structure is typically expressed as a debt to equity or debt to capital ratio. Now in simple, what is capital structure means? The types of or the sources of raising a capital for a company. It can be by issuing of equity shares or by issuing debentures. So every company has to make this decision or a choice as to how much of debenture or as to how much of equity should I raise capital for the purpose of my company or the purpose of my business. Okay, so the decisions taken up or the choices made by the management or the company about the capital is called as capital structure. Hope the meaning of capital structure has got to you. Let's understand what are the various factors influencing capital structure. So before the management or the company has to decide this is the amount of equity or this is the amount of debenture that my company needs, there are a lot of factors that affect that decision making. Few are external factors, few are internal factors. External factors are government regulations, market conditions, investors' attitude and taxes. Internal factors like business and financial risk, cost of capital, trading on equity, control over companies' affairs, nature and size of business. Let's study individually. External factors first. Under that we have the first point, market conditions. Now these are the conditions or situations that are prevailing in the current market. Okay, if the share market is in a declining situation, the company should raise funds by issuing debentures. On the other hand, if it is a period of boom, then the share market, the company should raise funds by issuing equity shares. So here the company needs to understand, first of all, how is the industry performing? How is the market performing? What is the flow of funds? What is the interest rate? What is the GST or the tax rate? Right? How are the investors' attitude? All these factors belong to the market where the company is situated in. Got it? So these are the factors which are happening in the market. I as a single company, can I control the market? Can I control the conditions happening in the market? No, but I am affected by the conditions in the market. Second, taxation. Interest paid against debenture is tax deductible expenditure, whereas dividend is not considered as tax deductible expenditure for the company. So I as a company need to understand from the taxes perspective, okay, because every company has to pay income tax to the government. From that perspective, I need to understand what is the amount of taxes I need to pay and how is that I can reduce my tax payment to the government, not avoid but to reduce the tax payment. The statement says interest paid on debenture is tax deductible. How is it possible? Now let's say your earnings of the company for a particular year is rupees 1 lakh and you're paying interest to debenture rupees 10,000. Further, I'll be teaching you income statement. So in that format, from the earnings, the first thing that you deduct is interest. Okay, first thing that you deduct is interest payment. After that only, the remaining income is called as taxable income, where tax percentage is levied on the income. So if I have debenture as a part of my capital structure, then 1 lakh minus that 10,000 interest, the remaining amount is 90,000. So my taxes will be paid on rupees 90,000 earnings. What if there was no debenture in my capital structure? Then the entire tax percentage will go on rupees 1 lakh, not on rupees 90,000. Whereas, is there any tax benefit with respect to dividends paid to equity shareholders? No. Tax benefit is only available when you are having debenture as a part of your capital. So companies first need to look into the market conditions prevailing in the industry, understand the happenings or understand the pros and cons in the market, and also need to understand the taxability of the company. The third point is legal provisions. So every company has an authority, is accountable to an authority. Let's say Companies Act or SEBI, Securities Exchange Board of India, or Reserve Bank of India, etc. Right? They have an accountability to certain authorities or certain government. So whatever those authorities are laying down provisions, rules, regulations, I as a company must be aware of that. Is that clear? It can be the government of India lay down provisions, regulations for IT companies or automobile industry or for agricultural sector. So whatever decisions they have made, the provisions they have made or the regulations they have made, etc., I need to abide by those rules and regulations. So companies also need to understand the legal provisions laid up in the country. So because this is going to impact how I am going to make my choices about deciding the combination of capital structure. Number 4, investor's attitude. Now remember, every investor is different. Every investor is going to choose his investment avenue depending upon his risk-taking capability. For an example, now if it's a newly employed person who has just joined his job or profession, he would always opt for those investment avenues which have low risk. Why? In fact, in case he loses that investment or loses that, wherever investment avenue he's put his funds into, there is no backup for him. There is no savings from him. He's just begin his profession. Where will he have his savings? So therefore, he'll always look for opportunities or avenues which have low risk taking. For an example, let's say the newly employed opens an recurring deposit account. That is a very, very safe option for him. It is lowest risk possible. Correct? Every month, a part of his salary will be moving to RD account and he will be earning interest for the same. On the opposite, let's look at people who have completed 30 years of profession or 30 years of employment. These are the people, or even people who are retired, can take up huge risk or take up high risk. Why? Even though they lose a part of their investment here, they have a backup or they have a savings from their last 30 to 20 years. Whatever they have saved, right, in terms of provident fund or in terms of savings or bank balance, etc., they have a backup. Okay, so they tend to take up higher risk compared to persons who are newly employed. So therefore, investors are going to differ in their attitude in terms of risk-taking ability. Some may take up low risk, some may take up medium risk, and some may take up higher risk, depending on what? Their income level or their savings level. Is that clear? So if you can observe the second line over there, if investors prefer to take risk and expect high returns, they invest in equity shares. If the investors prefer to earn safe and assured income and are not ready to take risk, they invest in preference shares or debentures. Why? If they are looking for a higher return, they take up high risk by investing in equity. Now, equity, if the company is facing loss, yes, you have to understand with the loss, but if the company is earning super profits, you will be the most benefited as an equity shareholder. But this earnings as equity shareholder is not guaranteed, okay? It is just depending on the company's performance. On the other side, you do not want to take up risk, or you want to take up very low risk, then as an investor, you will automatically opt for debentures. Why? Irrespective how the company performs, company has to make a payment of interest to debenture holders. So these are the 4 points of external factors. Moving on to internal factors. First one is business and financial risk. A firm with high business risk prefer to have low levels of debt since the volatility of its earnings is more. A firm with low level of business risk can have a higher debt component in capital structure because its earnings is lower. So the higher proportion of debt increases the financial risk of the company with regard to fixed charges and repayment of principal amount in time. First, let's understand. Now, internal factors means those factors which are within the control of the company. Okay, I can use it for my benefit. I can change or alter it to my performance according to the performance of my company. Let's understand what is business risk first. What is business risk is, if a company is able to run its business smoothly. What do you mean by business running smoothly? Means the availability of raw material, availability of machine, current or go down, the place and the conversion of raw materials into finished goods, everything. This entire process of manufacturing is being unaffected. That means it's going on smoothly without any hindrance. That is called as business running smoothly. What is business risk? Simply, if the business is not able to run smoothly, that means the raw materials are scarce, or the machine breakdown is happening, or you're not able to pay your small stationery bills, or you're not able to pay the wages of the labor working in your factory. This is called as business risk. Understood? Business, if it's not able to run smoothly, not able to make its small payments, then it is called as business risk. On the other side, what is financial risk? Financial risk means, now if the company has issued debentures, I just told previously, irrespective of the company earns profits or losses, they are liable to pay interest to the debenture holders. What happens if I fail to make the payment? Debenture holders will simply file a case against the company, or they may even come and sell the assets of the company and then take back their money. So nobody, I as a company cannot stop them from filing a case against me, or I cannot stop them from selling a asset of the company. Correct? Why? While at the signing of the debenture document itself, it is a secured debenture. That means they have a right over the assets of the company. Now, which company would like its assets to be sold? Definitely not, right? Or to be sued by the debenture holder. Now, this part, when the company fails to make the payment and the debenture holder takes action upon the company, is called as financial risk. Or in simple, the capability of not repaying back the interest or principal amount to debenture holders is called as financial risk. Now, I as a company, it is my internal factor. It is I who decide how to run my business smoothly. It is I who decide how much financial risk can I take up. The statement says, if my earnings are constant, okay, if I'm confident that my company is going to boost up sales, or my company is going to have huge earnings, then my company can take up a little bit higher debenture. Because why? I'm confident from this profits I can pay my debenture holders interest. On the other side, if my volatility of my earnings is very low, I am not at all confident that my companies can run successfully, my company might lose the sale profit in the market, etc. If I am not that confident about my earnings, then I cannot take up much debentures. I can take up very, very low percentage of debenture as a part of my capital structure. Got it? Hope you've understood the concept of business risk and financial risk. Second part is cost of capital. So, the cost of capital of raising debenture is always lesser to cost of raising equity. As I told, interest paid on debenture is tax deductible, or it is going to decrease my taxable income. Therefore, the cost of debenture is always lesser than the cost of equity. So, it directly depends upon the degree of risk. The expected return depends upon the degree of risk. If the company is able to take up a higher risk, then the cost of capital also will increase. If the company does not want to make much risk, then the cost of risk will automatically come down. Understand? So, company needs to understand and decide. It is within the power of the company as to how much cost of capital or expenditure the company can take up. Number 3 is trading on equity. Now, this is a very interesting concept. It is the use of borrowed capital for financing a firm. If the rate of interest on debt is lower than the rate of earnings of the company, the equity shareholders get additional dividend. Notice that word, the equity shareholders get additional dividend. This increases the credit worthiness of the company, and the company is able to raise further loan at a lower rate of interest. Now, trading on equity means, now first I told you in terms of taxes concept that interest paid on debenture is tax deductible, or it's going to reduce my taxable income. There's also one of the major benefit having debenture as a part of a capital, two major benefits. Number one, it's going to reduce my taxable income, I already discussed with you. Second is, it is going to maximize my equity, or it's going to maximize the earnings of equity shareholders. Ultimately, who are the equity shareholders? The owners of the company. The owners of the company must get the maximum benefit of the company's profits. How? By trading on equity. Otherwise, by having debenture as a part of your capital, you can maximize the earnings of the equity. Now, because I have lesser taxable income because of interest, then I have more portion of my profits to be divided or distributed to my equity shareholders. That is the statement there. The equity shareholders get additional dividend. Okay, hope you have understood the cost of capital concept and the trading on equity. Number 4, size and nature of the company. This will definitely have a greater impact on the company's decision on capital structure. So, small companies definitely can't look for to raise funds from external sources, whereas large company will have all the opportunity to raise huge funds because they can have a security as land, building, machinery, etc. Now, the decision of the capital structure widely differs from a sole proprietor to a partnership firm to a trader to a manufacturing concern, for an MNC, for a small scale company, and so on. So, each company, according to the size and according to the nature, the capital structure is going to differ accordingly. For an example, if for a manufacturing concern, what does manufacturing concern deal with? It is a it's a large scale company. Definitely I am going to manufacture, let's say I am involving in manufacturing of textiles, I manufacture clothes. So, my raw materials are cotton or other kinds of fabrics, I convert them into finished goods. So, I need a big factory, I need a godown to store goods, I need machinery, I need people, I need lot of other things to convert my raw material into finished goods. Now, here let us look at the capital structure point of view. Do I need more investment into fixed capital or do I need more investment in working capital? I need more investment in fixed capital. Reason? The setting up of godown involves huge investment. The setting up of factory, investment, technology, machines, all these are huge investment. So, for a manufacturing concern, the capital structure would more focus on fixed capital. On the other side, what about working capital? The manufacturing concerns won't have smaller, not much of smaller expenditure like paying of wages or paying of electricity bills or other stationery expenses. All these are lesser compared to the amount of fixed capital. Let's say on the other side, if I am a trader or I am a retailer, I just collect or purchase goods from different wholesalers, a bunch of goods, and I display it in my shop, or just a one particular room or a shop. I display my goods and start selling my products. Now here, what kind of capital do I need more? Fixed capital I need more or working capital? Of course, I need more of working capital. I don't need to invest much into fixed capital. After all, I just need one particular room or a particular location where I need to sell my goods. That's it. All the other things are just temporary for me. Therefore, for my working capital, I need more amount of money than compared to my fixed capital. So therefore, the size and the nature of the company will impact or will help you decide better in terms of what combination of fixed capital or what combination of capital structure do you require. Fifth point, the last one, control over company's affairs. Now, who are the decision makers of the company or the management? It is the equity shareholders, because they are the owners of the company, they have voting rights and they are the decision makers of the company. Now, if I as a management, we are already 500 equity shareholders, okay. I don't want any further number of people joining our decision making meeting. Then, if I want to retain more control over the equity or retain more control over the company and the business affairs, I will decide not to raise any more equity. Because the moment I raise some more equity share capital, there are going to be more people coming into the meeting and voicing their opinion or decisions. Correct? On the other side, what if I want to raise more debentures? Okay, more debentures. Now, are debentures bothered about the decision making about the company? No. Debentures are neither bothered what kind of decisions the company makes, what kind of choices they make. No. All debentures want is timely payment of interest. That's it. How you're going to earn it, what kind of decisions and choices you're going to make, debenture holders have no right in giving their choices or opinions in the general body meeting of the company. So, if you have debentures, they are not going to control the company. They just want interest. But if you're going to raise more of equity, then your control is going to be affected. There are going to be more people voicing your opinion in the meetings. Understood? So, internal factors affect or are within the control of the company to alter or change for the better performance of the company. So, today we have studied the meaning of capital structure, the factors affecting the capital structure. External factors we studied market conditions, taxation, legal provisions, investors' attitude. Internal factors we studied business and financial risk, cost of capital, trading on equity, size and nature of the company, and control over the company's affairs.